Good morning and welcome to the Killik and Co market update. Markets had quite a nice rise towards the end of this week following the publication of the latest minutes from the Federal Reserve. US interest rates and US interest rate expectations are key drivers of market movements, especially at the moment, and therefore any comments from the committee that sets them are very important and they tend to be analysed down to the last word. The latest set of minutes was actually quite positive about the state of the wider US economy. Obviously, the minutes acknowledged the need to bring down inflation, but they were quite positive about the levels of business investment and household spending, and also about the state of the US jobs market. Clearly, there is a need to get this inflation under control, and the fact that the Federal Reserve is keen to do this by raising interest rates is the reason why markets have come down quite a lot this year. But behind that, I think there has been a concern that the Federal Reserve will continue to raise interest rates aggressively in order to bring down the inflation, no matter what impact that has on the wider economy. However, there was a comment in the latest set of minutes that implied that that won't perhaps be the case, and I think that's the reason why markets reacted positively to this latest set of minutes. And this comment said that members agreed that in assessing the appropriate stance of monetary policy, they would continue to monitor the implications of incoming information for the economic outlook, and that they would be prepared to adjust the stance of monetary policy as appropriate in the event that risks emerge that could impede the attainment of the committee's goals. The big news in the UK this week is this windfall tax on energy stocks. Rishi Sunak initially said he was opposed to this, but he seems to have done a big U-turn and the tax was formally announced this week. The tax will focus on companies extracting oil and gas from the North Sea, and these companies will be eligible for relief on the tax if they invest money back into the UK. Although many oil majors have been quite critical of this move, the fact is that actually the impact of this tax won't be too severe for these large companies. And this is for a couple of reasons. One is that these companies are quite international in nature, and actually their operations are based all around the world and they have limited exposure to the UK. And the second reason is that these companies are integrated, they're active across all stages of the fossil fuel life cycle, and therefore they're not overly exposed to the extraction process. By looking at this slide here, you can see that shares in BP and Shell were actually up on the day of this windfall tax announcement, and that really demonstrates that they're not going to be overly severely impacted by the tax. The companies that will be hit the hardest are those that are very focused on the UK and very focused on the extraction process, for example, Enquest and Serica Energy, as you can see. Although these companies have clearly benefited from the recent spike in oil prices and they have made supernormal profits over the last few months, they've actually underperformed the FTSE 100 index over the last 10 years. Here on this chart, we've got the FTSE 100 index along the top in the green, we've got shares in Shell in the black in the middle, and then shares in Enquest in the pink along the bottom. And you can see that shares in Shell and Enquest dropped quite heavily in 2014-2015 when there was a big drop in the oil price. They then dropped further in the period of lockdown when there was very little demand for oil, and it's only in the last few months that these share prices have really had a decent rise, but they're still behind the FTSE 100 index on that 10-year basis. And just back to the subject of this windfall tax, it won't be covering electricity generation companies for the time being. Earlier this week, there was quite an unexpected announcement saying that Rishi Sunak had requested a report about the impact of potentially taxing these electricity generators, including renewable companies. And you can see this had quite a big impact on the shares of SSE. The following day, SSE published results and they were better than expected, sending these shares up again. But on the day that this windfall tax was announced, it did say the tax won't initially apply to these renewable companies, but that these companies could be taxed in future, and that sent these SSE shares down again. It's difficult to say how a tax on these companies could look in the future, but I do think that a high tax would be quite unlikely, the reason being that would really impede the UK's investment into renewables, and that would have a really negative impact on the UK's goals to reduce its carbon emissions. And finally this week we've had some weakness in social media stocks following some very disappointing results from Snap, which is the company that owns Snapchat. You can see from the chart here that the shares plummeted and they're now below the level at which they listed back in 2017. It is worth bearing in mind that Snap has never been a profitable company, and therefore it is quite different to some of the more established social media companies such as Meta, which owns Facebook. Moving on to have a look at next week, it's looking fairly quiet on the calendar and we're just looking forward to results from Salesforce over in the US. We won't have a video next week because of the double bank holiday here in the UK, but we look forward to seeing you in 2 weeks' time.